Savita Subramanian, head of equity and quantitative strategy at Bank of America Merrill Lynch. And Savita, thank you very much for joining us. I know you're bringing down your S&P target today. We read the note. I guess, is there a point, and maybe you have to from a risk management or compliance perspective, is there a point at this point in even having a price target on the S&P 500?
Yeah, no, it's a good question. I mean, I think that, you can always assign a fair value to the market based on a normalized earnings framework and, a cost of capital assumption. But in times like this, it almost feels irrelevant and fundamentals seem to take a backseat to other factors. I think what we try to do with our forecast is incorporate a lot of different frameworks. So we have a fundamental read. We also have a sentiment read, which is actually the most bullish right now in that everybody is freaked out and uncertain about the future, which is generally a good time to buy. And then, then we also have our fair value model, which says that earnings are cyclically peaked. We are about to see the biggest recession in modern history. It's going to take a couple of years to get back to the earnings levels that we saw at the end of last year. So I think there are puts and takes, but all of that combined together, to your point, I think point-in-time forecasts are a little bit silly, but I think what we're seeing right now is the idea that we get through this year. I agree with whoever said we're likely to be in a range-bound market, but I think what I'm looking at that seems really encouraging is that once we get past 2020, if you think about what's going to happen this year, I think it's going to be a bad year for earnings. We have a 30% drop in earnings forecasted. But that means that companies can basically throw all of their bad stuff into this year, have, a terrible decline in earnings and have a great scapegoat to blame it on. And then come 2021, it's clean slate. And typically the earnings recovery coming out of a recession is pretty strong. So I think that at some point this year, we'll start to think about next year's earnings. We'll look up to the other side of this. And that actually looks like a pretty good environment. We've got a
Well, I can't speak for you, Savita. I've already started thinking about next year. I just want to be clear. 2020 has stunk in every possible way, and I think everybody out there is probably just thinking, just throw it away. It's March 97th, April 2nd. We've already lived a full year. That aside, have we reached enough pessimism among your clients? We've got all this data that shows that mom and pop, they're still holding on. The retail investor is not generally selling. Do we need that second layer of just, and I don't want to see the markets go down, but you understand what I'm saying, that there's still a buying bias out there?
Possibly. There's still a buy the dip mentality. Maybe we need to see complete capitulation. I mean, I do think that the encouraging sign in terms of providing a floor for equities is the fact that the Fed seems ready to buy almost anything to keep liquidity in place. And, the fact that they're now buying investment-grade bonds, I mean, it's unprecedented, but it signals that if the Fed is willing to buy risk assets, that's a decent floor under the market, and they can buy as much as they want. So I think that is the we still have this moral hazard of a Fed that's willing to do whatever it takes to keep things going. So that's why I think it doesn't get too ugly from here. But to your point, I mean, one of the things we've noticed in our our desk data, in our flows data, is that individual investors have been shedding exposure to stocks through ETFs and passive. But they have been buying single stocks. And I think that's an interesting way to play this. I actually agree with what individual investors are doing because I think this really is a stock picker's market.
Yeah. You know what? You wonder if it's going to bring back stock picking, Savita, because simply a lot of these ETFs, they may have a couple of good companies in there that are going to make it and a bunch of companies that are not going to make it. So you just kind of avoid the whole thing. The carrot ruins the pot pie, if you will.